Have you ever wondered how an entire country keeps track of every single dollar, euro, or yen that flows in and out of its borders? Well, today we're going to demystify a huge concept you probably hear about all the time, the balance of payments. Let's get into it.
I mean, seriously, how does a country manage to track all of that? Think about it. Every single car that's imported, every app you buy from a foreign company, every single investment made overseas, it all has to get tallied up somewhere, right?
Well, the answer is this really important economic tool called the balance of payments, or BOP for short. The best way to think about it is like a country's financial report card with the rest of the world. It adds up all those international transactions, usually over a quarter or a full year.
So, here's our plan. First, we'll cover what the BOP is and its basic rules. Then we'll break down the two big parts, the current and capital accounts. After that, we'll tackle what those terms deficit and surplus really mean. And finally, we'll talk about why any of this actually matters.
Okay, let's dive right in. To really get the BOP, you have to understand its one single, most fundamental rule. Just like in business accounting, the balance of payments has a golden rule. It always has to balance. That's the key. By definition, for every single transaction that goes on the books, there has to be an equal and opposite entry to match it.
And this slide really breaks it down to its simplest parts. Every single international transaction boils down to one of two things. A credit means money is flowing into the country, like when we export something. And a debit means money is flowing out, like when we import goods from somewhere else. Simple as that. Money in, money out.
Okay, so let's see how this whole credit and debit system builds the first major component of the BOP. This is the current account. And trust me, it's the one you hear about in the news all the time.
So what is it? You can think of the current account as the summary of a country's day-to-day business with the rest of the world. It's tracking the value of everything a nation sells to other countries versus everything it buys from them.
This table breaks it down perfectly. First, you've got merchandise. That's all the physical stuff, cars, phones, food. This part is often called the balance of trade. Then you have services, like tourism or consulting. Next is income, which includes things like dividends an investor gets from a foreign stock. And finally, you have transfers, which are basically one-way payments, like foreign aid, or just sending money to family overseas.
And these examples really show how it works. A U.S. publisher sells books to Ireland. That's money coming into the U.S., so it's a credit. JCPenney buys stereos from Indonesia. That's money flowing out, so it's a debit. An American investor gets a dividend from France. That's income from abroad, a credit. And the U.S. giving aid to Costa Rica, that's a one-way transfer out, which makes it a debit.
All right, so that's the current account, the day-to-day stuff. Now let's move on to the second major piece of this puzzle, the capital account. And this one is all about tracking bigger, long-term investments and who owns what.
So this account is tracking the buying and selling of assets across borders. We're talking stocks, bonds, real estate, you name it. When a foreign company decides to build a new factory in your country, or when you buy shares in a foreign company, that transaction gets logged right here.
It's mostly broken down into these three categories. You've got foreign direct investment, or FDI. That's for big, lasting investments, like building that factory. Then there's portfolio investment, which is more about buying financial assets like stocks and bonds where you don't really have direct control. And finally, other investments covers things like international loans and even bank deposits.
Okay, so this brings us to a really important question. I keep saying that the balance of payments always has to balance, right? So how is it even possible to have a trade deficit or a surplus? What's going on there?
Well, the secret is a third special account called the Official Reserves Account. This is the one held by the country's central bank, and you can think of it as the ultimate balancing item. It's where they keep assets like foreign currencies and gold. And it all comes down to this super simple equation. The current account plus the capital account plus that reserve account, they always have to add up to zero. It's a rule. So if one account is negative or in deficit, the others must be positive or in surplus to make it all balance out. And here is the absolute key takeaway. When you hear about a trade deficit on the news, they are not talking about the entire balance of payments. Nope. They are almost always talking about a deficit in just one piece of the puzzle, the current account. So, a current account deficit just means that a country is buying more stuff from the rest of the world than it's selling to them. Now, that's not automatically a bad thing. It could mean the country is bringing in money to finance productive investments. But if it goes on for too long, it's definitely a number that makes economists pay very close attention. Okay, so we've gone through all this accounting, but why does it actually matter? In this last section, we're going to see how the BOP has some pretty serious real-world consequences for all of us.
So, why watch this stuff so closely? Well, for one, it directly affects the value of your country's currency. A big ongoing deficit can push its value down. It's also a big indicator of how competitive a country's industries are. Plus, it signals to the rest of the world whether a country is a good business partner. And maybe most importantly, governments use these numbers to make huge policy decisions, like raising interest rates, which can affect everything from your mortgage to your car loan.
So, at the end of the day, the balance of payments really does tell the story of a nation's economic relationship with the world. It shows whether it's saving or borrowing, and it reveals how strong its industries are. It really is an economic report card with a grade that's constantly being updated. Which leaves us with one final thought. What kind of story is your country's report card telling right now?